And we're live. All right. So the topic of today's discussion is going to be about the Japanese economy and especially the ultra loose monetary policy we've seen in the news a lot since Japanese Prime Minister Fumio Kishida came to office in October 2021, and especially in the lead up to the appointment of new Bank of Japan Governor Kazuo Ueda back in April 2023. There's been a lot of discussion about Japan eventually changing its ultra loose monetary policy. So I thought it'd be really great to discuss this with you, Marcus, since you are a resident expert on all things economic, including, I assume, Japan. So I did want to start with a few questions here, and I'll list them, and then we'll get to them one by one. So first, sort of what's the original motivation for this policy? And I guess we don't have to dig too much into the history, but why did they ever start this policy? And then why is there an impetus to change? And then what are the sort of short and long-term impacts of this change, especially given Japan's economy right now in this sort of post-COVID era? So could you start us off with sort of like, why did they ever have this policy, and then what's unique about it?
Yeah, sure. So this goes back a long time to the late 80s, early 90s, when Japan suffered a major financial breakdown related to overextended lending, a major real estate crisis. And then it really sort of went into a deflationary mode, low economic growth. That's why people talk about a lost decade or even lost decades. And then in the early 2000s, because of persistently low inflation, in a way, the Bank of Japan was innovative and introduced quantitative easing. So in other words, they bought financial assets on a very large scale to also bring down longer term interest rates. And then there's some sort of quirks around this, going back to like 13 and 16. Now, I'm not going to bore you with the details of this, but the basic idea was that Japan was suffering from deflation. So in other words, the price levels were declining and economic growth was not really there, or there wasn't much of it. But that's a bit of a misconception, because in fact, Japan did grow in real terms. It's just in nominal terms, it wasn't really making much progress. And so by and large, so leaving aside the tweaks the Bank of Japan made to that policy, that policy is still by and large in place. So fast forward to like 2020 and 2023, the central bank still effectively keeps a negative short-term interest rates, 0.1% on the policy rate, and essentially the 10-year bond yield, which is kind of the sort of base rate for the rest of the economy, is still anchored at zero. And they've made some tweaks around this. I'm happy to talk about this. What's interesting about this is that Japan continues to stick to a very expansionary fiscal policy in terms of quantitative easing and low interest rates, while the rest of the world obviously has moved on. And so perhaps to tackle the second part of the question, what is Japan, or what is the Bank of Japan thinking of doing? Well, they're now in this sort of sticky situation where inflation is way above their target and their monetary policy is still super, super loose. So the question then is, what will they do going forward? And that's something we're trying to figure out as well.
So I guess we just discussed this this morning as well. I sent you a news item, but there was a Bank of Japan meeting today. And I was a bit confused by it. You helped me through it a little bit. But the idea that Kazuo Ueda was saying that inflation rates remain higher than they had previously expected, and thus they are not raising interest rates, which to me seemed contradictory, but you explained it quite well in chat, so I thought it'd be good to briefly touch on it here too.
Yeah, sure. So as I said, the situation the Bank of Japan is facing, that inflation is running higher than what their target is. So their target is 2% inflation, depending what measure you use, is running at 3 or 4%. And it has been running above target for really a year and a half now. And so it's kind of sounding contradictory to say what Ueda said, but in reality, the Bank of Japan is still concerned. They recognize inflation is high, but they are concerned that Japan will slide back into deflation. That's why they're very, very hesitant to raise interest rates or sort of make any major tweaks to their monetary policy strategy at this point. So the sustainable really refers to the fact that in an ideal world, Japan would be running a 2% inflation rate. That is also the target set by the Bank of Japan. And the concern right now is inflation is, yes, it is above the target, but there's still very significant concerns. And it's also reflected in the government's inflation forecast that inflation will move back towards target in 24, 25, and then the risk of deflation will reoccur. And I think just a quick thought on this, I think that's not entirely implausible, because you have to ask yourself what will be different 2025 compared to 2020. Now, we can tell a story as to why things are different, the green transition, higher energy prices, and so on and so forth. But then we're going to have a discussion about what really drove deflation in the first place. And that's a separate discussion. But that's in a nutshell what the Bank of Japan is struggling with at the moment.
Okay. And so the timing around this is obviously a big question mark. Every time there's one of these policy meetings, there's a lot of sort of media coverage. Will he, won't he change it? More often than not, they don't change the policy rates. But when they eventually start doing this, when they start making sizable upticks, and as you mentioned, they have made minor tweaks. I think back in July they made a minor tweak. But once they start doing this, is there anything unique about the Japanese context that we should consider here? Because in general, you start raising interest rates, you start worrying a little bit about weighing on economic growth. That's supposed to help inflation moderate a little bit. But Japan's, as you mentioned, has been in this unique spot. They're used to deflation. They're quite excited to have some modicum of inflation, and they're in a post-COVID period, so they don't want to crush the recovery. So is there anything unique about the Japanese economy, particularly coming into this change, or is this just going to be like any country when they start going from sort of loose to tight policy?
So I think you can make the argument that structurally Japan is in a worse position. So if you believe that demographic trends are really having a huge impact on deflation, then Japan is probably in a worse spot than most other countries. But you have to sort of buy into that premise. But specifically when it comes, so in that sense, they should be more cautious. And I think that's why they are being more cautious than many of the other central banks, even though in all fairness, inflation didn't spike as high as it did in Europe and the United States. But in terms of your question of exiting that policy, that's always tricky. I remember back, I think, when Bernanke was still at the Fed, they also tried to launch quantitative tightening. So in other words, rolling off the treasuries that the Fed bought, and that sort of created some market wobbles. I think in the Bank of Japan, this could be even more serious, not just because of the structural position the economy is in, but also because in many ways, the Bank of Japan has a much more aggressive monetary tightening policy and quantitative, easing policy rather, but monetary tightening and quantitative easing. In the sense that they not only are short-term rates negative, whereas in the US they were sort of zero, the Europeans also had a negative rate, but more importantly, effectively the Bank of Japan has been committed to capping the yield on the 10-year bond in particular. So exiting that could create even greater wobbles. Like most of the other central banks didn't specifically target the yield cap, and so this might be harder. And also not to mention the fact that, of course, the Bank of Japan owes about 50% of JGBs, of Japanese government bonds. So that also adds another dimension to this. But I do think it's this combination of being structurally in a more deflation, being at more risk of deflation, and then secondly, just having such a huge balance sheet. And the trick to my mind is that I think Ueda wants more policy flexibility. So he needs to make some changes, but he can't really push these changes too far without signaling to the market that quantitative easing is sort of a thing of the past, or the central bank won't step in as aggressively, because that then fuels potentially expectations about further deflation. So it's a tricky situation to be in for the BOJ.
Yeah, from my understanding, it's a conundrum for them, but they have to wade through it. Is you want to resume using monetary policy, what you could say is properly, which is not just having a flat negative rate for a long period of time where you hike it at certain periods and you drop it at certain periods. They want that ability back, but to do that they have to weigh on the economy for a short term. So it's in order to gain monetary policy flexibility again, they have to sort of eat the costs, and they have to time it correctly so that when they do start eating the costs, they don't tank the Japanese economy. Is that understanding it correctly?
Yeah, I think that's broadly correct. And more importantly, because the policy is so rigid in many ways, saying the yield on the 10-year has to be X, and we're going to buy whatever JGBs are in the market to make sure we're hitting that yield. So exiting that policy then could create even greater market wobbles, which to my mind is exactly why the BOJ over the past, 9-10 months has made small changes to this. So initially, they're still sticking to their 0% yield target on the 10-year, but they moved the band around it from 25 to 50 basis points. And then they also said the 50 basis points is not a hard target, it's guidance. So I think what they really don't want to do is, if inflation were to move out of control, they might be forced to change monetary policy very quickly. And that's something central banks do not want to do, which is what they're trying to do now, is give themselves greater flexibility to be able to then make that shift without disrupting financial markets too much.
And is there, you sort of touched upon it a little bit there, is there an immediate sort of pressing debt conversation here to debt sustainability in the long term? Because I've heard it discussed that, the Japanese government owns most of its own debt, so to speak. So it's internal to Japan that sort of helps it be able to manage these issues a little bit more easily than if they owed it to other countries. But there's also the idea that and I'm sort of stepping beyond the bounds of my knowledge on the economics here, but as far as I understand it, the Japanese government has been spending higher and higher deficits every year, but it's been okay because they've had such low interest rates on those bonds that they're able to pay the interest, and it really doesn't hurt their revenues too much. But if they start raising interest rates, then you start having higher bond interest rate payments relative to the principal, and so they have to. That becomes a pressing need. It's no longer a kick the can down the road. Eventually, we'll deal with that. But it's now this is growing and starting to hit our revenues. We actually need to deal with that. Is that a pressing issue here, or is that somewhat separate from what we're looking at with the Bank of Japan monetary policy changes?
I think it's something the BOJ keeps an eye on. I don't think they're probably too worried about this at this stage, because as you rightly say, what's happening, or what's been happening for years, is not only does the BOJ absorb all this government issuance, but they also keep interest rates at very, very low levels. On the other hand, if you're really worried about debt sustainability, and it's also correct what you're saying, that Japan owes money, so that in a sense, the government owes money to the central bank, which effectively means it owes it to itself. And then to the extent that the debt is still out there, it's largely held by Japanese investors. So in that sense, Japan is sort of quite different and not particularly vulnerable to any kind of external disruption to its debt situation. But I think the way to think about this, and this is, I think, also broadly true for the United States, if you have higher inflation, so what matters is not so much the nominal interest rate. What matters is the real interest rate, and what matters is not so much whether you run a deficit, but what overall inflation is. So, just a conceptual example, if you have 100% debt to GDP ratio, so let's say this is debt held by the public, and you have a 5% inflation rate, then your nominal debt, so your debt to GDP ratio is going to drop 5% no matter what. So you can allow, for example, debt payments to go up by 1 or 2 percentage points of GDP, because debt still falls. So I don't think this is a huge issue, and it's something the Fed, presumably, the BOJ is probably, like, again, keeping an eye on. I do not think that this constrains the BOJ's choices, because also remember that primarily they have that mandate is to bring inflation to 2% on a sustainable basis. That is first and foremost what they want to do. Now, I'm not saying they don't keep an eye on financial stability risks, but I think their concerns are much more around, if we exit this current policy, what will it do to the financial system? Will that be disruptive? And I think only secondarily will they worry about public debt. And I don't think they really should worry about this at this stage.
Okay, just one last question. It's half hypothetical or rhetorical, pardon me, but also I did want your thoughts on this. Generally, when you start hiking rates, it's not something that is viewed positively by the public, because it starts to weigh on economic growth, but it also helps with inflation if inflation is running away. So are they in sort of a political bind where the Kishida government, who's doing sort of okay in approval ratings, not the best, and is the LDP, the ruling LDP as well, is it possible that this is something they're holding off on until they're in a better political spot? I know there's the idea of the independence of the Bank of Japan. Some people say it's a little bit less or more independent than other central banks. But is this also a political issue, or is it sort of 6 of one, half a dozen of another, so it's not likely to weigh much on that calculus?
So I can't speak for the Japanese government, but if I were to advise the Japanese prime minister, I would say let the central bank do what it's doing, because the concern, I think, is, yes, inflation is perhaps a problem. On the other hand, what you're also seeing is faster wage growth. Now, that might not help, for example, pensioners who presumably their pensions are indexed to some sort of, or they're not indexed, so they're losing out in some ways. But I do think the concern has been mostly about deflation. And of course, the other problem is that if you raise interest rates now, then you might slow the economy. And I would imagine, at this stage, still, when inflation is running at 3-4%, which is sort of relatively unprecedented, at least in the past, if you will, like 30, 40 years, running it at that level is probably not that politically disruptive, versus if the central bank tightens policy or exits quantitative easing or does some of the other tweaks we just discussed, then the risk is that the Japanese economy might sort of dip back into recession. I would imagine that's a greater risk from the government's perspective. And so to that extent, and by the way, I also do not think overall, you might be right, that BOJ might be somewhat less independent, say, than the ECB, for example. But I wouldn't go as far as saying that Bank of Japan is sort of beholden to the Treasury or the Prime Minister. So I think at this stage, I don't see too much of conflict between those two. But if I were the Prime Minister, I think I would sort of say, well, inflation aside, that's kind of the central bank's fault. But you didn't necessarily want to see the bank raise interest rates, because then the risk of a recession increases. And I think this will be more damaging to the ruling party than sort of inflation at 4-3%, which again, presumably is going to tick down to 2% over the year next year or so.
So it seems like the political, the economic, the fiscal, all the elements of this are pointing to a continuing, quite slow shift out of their old policy, rather than any sort of rapid hikes that sometimes gets thrown around in the media.
I think that's about right, because the last thing you want to do as a central bank is surprise markets. That's something you don't like. So, and I think if there's a major, they're doing a review right now, and again, it shows you how slowly they're going. They're doing a review, then they'll discuss it, and then they propose changes. So they do not want to spring surprises on markets. And if the inflation forecast is correct, and inflation continues to sort of trend down over the next 12 months, then I think they're in a good spot to give them more flexibility without necessarily upsetting the markets too much. So next time inflation goes up, they don't have to surprise markets. They have the instruments in place to manage this in a more forward-looking manner.
That's a good forecast to end on. For our listeners and watchers, if you'd like to peruse our analysis on this and many other geopolitical topics of the day, please check out our content at worldview.stratfor.com, or you can learn more about our business services at ranenetwork.com. Thanks so much, and thank you, Marcus.
Thank you, Chase.
Perfect. Thank you.
All good?
Yeah. Amazing.
Okay, great.
All right. Have a nice week.
Have a good weekend. Bye.